The Fed did not hike rates, but the dot plot did the work for them. Wednesday was Kevin Warsh's first FOMC meeting as chairman, and he delivered exactly what he promised. Less words, more impact. New here, subscribe. Free note in the description. Let me give you what changed. The rate stayed at 350 to 375. Fourth straight hold, 12-0 unanimous. No surprise there. The statement got slashed from 340 words to 130. Forward guidance? Gone. Deleted. Warsh doesn't want the Fed telling markets what comes next. He wants markets reading the data. Then the dot plot dropped. And that's when the selling started. 9 of 18 FOMC members now expect at least one rate hike this year. 6 expect 2 or more. 1 expects 3. 3 months ago, the median was 3.4%. Wednesday, it's 3.8%. That's a 40 basis point hawkish repricing in one meeting. The market had been pricing 60% probability of a hike by year-end. Now it's 100% by October. The rate market adjusted violently. 2-year Treasury yield shot up 15 basis points to 4.22%, the highest since February 2025. Dollar index surged 0.87%, biggest single-day jump in 3 months. Gold got wrecked, down more than $150 intraday, closed at $4,259. Warsh at the press conference. 5 years without hitting 2% inflation. Time to fix it. He did not submit a dot plot. 1 of 19 was missing. He called the dot plot not helpful for executing policy. The message was clear. The era of the Fed telegraphing its next move is over. The equity market reaction was broad but not uniform. S&P 500 closed at 7,420, down 1.21%. Nasdaq dropped 1.34% to 26,721. Dow fell 0.98% to 51,492. Megacap tech got hit hardest. Meta tumbled 5.44%. Microsoft down 3.79%. Amazon down 3.46%. Tesla down 2.05%. Rate-sensitive names, all red. But here's the divergence that matters. Caterpillar rose 1.11% to 955.92. It touched 975 intraday, another all-time high. While tech was repricing for higher rates, industrials kept grinding. XLI held. PAVE held. The Iran deal, lower oil, infrastructure spending, these are real economy catalysts that don't care about a 40 basis point dot plot adjustment. CAT was the signal in the noise. NVDA closed at 204.65, down 1.33%. That's the entry zone from Tuesday's setup, 204, 205. So the FOMC dip actually delivered the price we were waiting for. Whether you took it or not, that's a different question. With triple witching Thursday, the trade isn't over yet. SPCX closed at 191.82, down 4.95%. It touched 213.80 intraday and gave it all back. That's 3 days now of intraday highs fading into lower closes. The options-driven gamma is working both ways now. Momentum has shifted. So where does this leave us for Thursday? 3 forces collide. Number 1, triple witching. Quadrillions in options and futures expire. This amplifies every move. Number 2, post-FOMC digestion. The hawkish shock is still being priced. Number 3, Juneteenth Friday. Markets closed. Nobody wants to hold heavy risk into a long weekend. My base case for Thursday: elevated volatility, direction uncertain. But the industrial trade is the cleanest relative strength. CAT up 1.11% on a day the S&P dropped 1.21%. That's leadership. If triple witching triggers a broad flush, Industrials on the dip remain the highest conviction watch. NVDA at 204.65 is at the zone. If it holds above 200 through Thursday's expiry, the setup from Tuesday is validated. If it breaks 200, the bond conviction trade from last week is under serious pressure. Risk reminder. Warsh said the Fed has 5 years of inflation failure to correct. He is not in a hurry, but he is not dovish. Every hot data point from here tightens the screws. Markets don't reprice rate expectations linearly. They overshoot. We're in overshoot territory now. One question. Warsh's first meeting. Hawkish or just honest? Drop your take in the comments. The dot plot wasn't a hike, but it was a message. Thursday is triple witching. Friday the market's closed. Plan accordingly. You know the drill. Subscribe, hit the bell. Free note in the description. Good luck out there.